What's going on, everybody? Liam O'Reilly, Vermont economic realtor. Hope you're doing well. Talking today about the Federal Reserve and their decision to raise the Fed funds rate by 25 basis points today. What that means, my opinion about it, and what Jerome Powell said in his speech, as well as the Q&A portion, and how that all affects the housing market here in Vermont specifically, but this will apply to other markets across the country as well. So the Federal Reserve, they clearly, I'm sure everyone's seen the headlines, raised their Fed funds rate by 25 basis points. And the sentiment of Jerome Powell and what he said about the data seems similar to what we've seen other members of the Federal Reserve say, and what we've talked about on the channel before, where Lael Brainerd talked about how they're going to keep their rate high and they're going to work to fight inflation, but that there's signs that what they're doing is working, and that's what Jerome Powell said. And now Christopher Waller, in his Q&A section a few weeks ago, said the same thing that Jerome Powell said today, that if they hike too much and they go too far and keep rates too high for too long, and we start seeing deflation or disinflation, the Federal Reserve is completely okay with that, and they don't mind dropping rates quickly or potentially slowly, however much they need to, depending on that data. But what they're really worried about is inflation just completely running away and pausing rates too soon. So this plays into what we talked about in previous videos, and the credit card debt and the student loan debt that's going to be kicking back in. With high inflation, people are struggling to pay their bills and are having to put more of their needs onto credit cards, which with these high rates, their payments are obviously going to be higher, and I think it's going to continue to impact CPI and inflation because people have less disposable income, and they're taking out debt to just survive. Which as that issue continues, we could see if that issue continues, we could see one, better CPI numbers and less inflation, and then two, the Federal Reserve start to act quickly and reverse on their Fed funds rate. Now, as far as the mortgage market goes and the housing market, I think this is great news as we move into 2023. The terminus of the Fed funds rate is in sight. Even if they keep their rate elevated for an extended period of time, we are going to have stability in the mortgage market. It's no longer, we're not likely to have question marks regarding how high are mortgage rates going to go, which is going to bring confidence to buyers as we move into 2023. Now, I think there's two sides to that equation, to that statement that I made. One, the Federal Reserve keeps with their expected terminus rate, or maybe right below that, somewhere between, we'll say 5% to 5.25. 5.25 is what they're predicting. The market is predicting 4.9. So somewhere in that range, as long as the Fed funds rate is in that range, we're not likely to see mortgage rates fluctuate drastically. But now the other factor in that is we need, in order to have stable mortgage rates, in my opinion, I think there needs to be fewer transactions, or at least the same amount of transactions as there were in 2022. Because the Federal Reserve is, while they're hiking the Fed funds rate, they are also unwinding their balance sheet, and they're no longer a purchaser of mortgage-backed securities. We've talked about this in other videos as well, but one thing that the Federal Reserve was doing over the past 10 years or so of quantitative easing, and certainly what they were doing in the most recent period of 2020 to 2021 when mortgage rates were low, is they were one of the main purchasers of these mortgage-backed securities. So they didn't really care about the rate of return they were getting when they were buying this bundle of mortgages. But as long as the Fed funds rate is elevated and the U.S. Treasuries are more elevated, they're around the 3% range right now, then investors are going to want a decent return on their money for these mortgage-backed securities. Now, the reason why I say transactions have to stay low in order to create stable mortgage rates is because the more mortgages that are being created, the more mortgage-backed securities there are out there to be sold on the secondary market to investors who would purchase them. And now the more mortgage-backed securities there are for the investors purchasing them, right? We have supply and demand. If we have a higher supply of mortgage-backed securities and demand is below that, then the investors can get their pick of the litter as far as mortgages go, and they will demand a higher mortgage rate, which will keep the mortgage rates in check and will keep prices in check. I think, you know, if supply is too low and transactions start to grind to a halt, then I think it's possible that we see mortgage rates drop a little bit, because it's kind of a fine line, because if mortgage rates drop and they come down, that's going to bring more buyers to the market. So this is really a supply constrained situation or scenario as we move into 2023. So if supply stays low and we see transactions start to slow, we can see mortgage rates drop because there's more competition from the investors who want to purchase those mortgage-backed securities. Now, on the other side, if we see supply increase and we see demand, flood into the market and more transactions happen than we're expecting, then it's possible that we see mortgage rates start to tick up a little bit. But the thing is, mortgage rates are only going to go so far, because the demand for homes at the prices that they're at, and the sellers that are willing to sell for less than what they want. There's only so many buyers who can afford mortgage rates as they continue to rise. So as mortgage rates rise, that's going to cut down the buyer pool, and there's only so many sellers who will want to sell for under what they could have got yesterday, for whatever reason, most likely because they need to sell and they're a motivated seller. There's only so many motivated sellers out there that transactions and prices are likely going to stabilize, as well as mortgage rates. So to summarize it all up, I think mortgage rates as we move into 2023 here are likely to stabilize because the Fed funds rate is more certain. So investors know what they can get on their investment, either with the reverse repo market at the Federal Reserve or with the Treasury in the Treasury market, which is going to stabilize the mortgage-backed security market. But if transactions start to increase, then we could see mortgage rates start to rise, because there are more mortgage-backed securities being made into existence than there are investors looking to purchase them. So they will want a premium, or they'll have their choice of mortgage to purchase, and they're going to choose the mortgage with the best rate, with the highest rate for them as the investor. So anyway, that's my thoughts. Let me know what you guys think. Do you think I'm right on the mortgage market in the 2023 housing market? Do you think I'm off a little bit? What did you think about the Federal Reserve speech today in the Q&A section? Did I miss something? Please leave a comment and let me know. All my contact information is listed in the description. If you're looking to buy or sell a home here in Vermont, I'd be happy to help you. If you're looking in another state across the country, I'd be happy to find you a great realtor so you're not stuck with somebody who doesn't know what they're doing. Other than that, my name is Liam O'Reilly, Vermont Economic Realtor, and I'll see you in the next video.